MU jumped 19.3%. Lab scores at 66 out of 100. Micron's yield on 1-beta DRAM is now 78%, up 14 points in 6 months. That's driving gross margins toward 42% despite 23% exposure to China tariffs. This rally isn't just cyclical, it's a node breakthrough. Micron's hardware dominance is an absolute chokehold on the AI server market, validated by its unmatched 1.2 terabytes per second, the rate at which data is transferred, bandwidth per HBM3E stack. While Wall Street obsesses over generic chip demand, the silicon reality is a brutal packaging bottleneck. HBM3E, High Bandwidth Memory 3E, the 3D stacked memory architecture designed to feed data directly to AI accelerators, is the gatekeeper of performance. Micron achieved this with its 1-beta process node, the lithography generation defining transistor density and power efficiency on the silicon wafer. This node bypasses EUV, extreme ultraviolet lithography, the cutting-edge chip manufacturing method using short wavelength light to print microscopic circuits. Instead, Micron uses advanced deep ultraviolet immersion lithography. This engineering choice yields a 24 gigabit monolithic DRAM, dynamic random access memory, the volatile silicon memory used for temporary high-speed data storage, die. It packs 30% more density than Samsung's equivalent generation. Look at the physical stack. Micron stacks 8 of these dies using TSVs through silicon vias, microscopic vertical electrical connections that pass completely through a silicon wafer. This creates a 24 gigabyte stack. The physical die thickness is shaved down to a mere 50 micrometers. That is thinner than a human hair. The structural challenge is thermal dissipation, the physical process of transferring heat away from the operating silicon dies to prevent thermal throttling. Micron uses advanced thermal interface materials to bridge the gaps. This allows their 8-high stack to run at just 2.5 watts per gigabyte of bandwidth. Compare this directly to SK Hynix. SK Hynix relies on MRMUF, mass reflow molded underfill, a packaging process that injects liquid protective material between stacked memory dies. Samsung uses TCNCF, thermal compression non-conductive film, a stacking method using thin insulating films between dies. Micron's proprietary thermocompression bonding achieves a tighter physical pitch, the center-to-center distance between microscopic interconnect bumps. This reduces parasitic capacitance, the unwanted electrical charge storage between adjacent physical conductors. It keeps signal latency, the time delay between a data request and the physical response, under 5 nanoseconds. This engineering edge makes Micron the exclusive high-yield supplier for the most demanding AI platforms. This silicon superiority translates directly into a massive supply chain advantage. The primary bottleneck in AI hardware is not logic processing. It is the packaging yield, the percentage of functional multi-die assemblies that pass final testing. When NVIDIA packages its GPUs, it uses CoWoS, chip-on-wafer-on-substrate, the advanced packaging technology that integrates multiple silicon dies onto a single physical base. If a single HBM3E stack in that assembly is defective, the entire multi-thousand-dollar processor is ruined. Micron's 1-beta node yields are reportedly tracking above 80%. This is far higher than Samsung's struggling 12-high HBM3E yields. This high yield rate reduces waste for packaging foundries. It guarantees that cloud service providers get their hardware on time. Furthermore, Micron's engineering choices insulate it from geopolitical bottlenecks. By utilizing deep ultraviolet lithography instead of EUV for its 1-beta node, Micron avoids the immediate capacity constraints of ASML's sole-source EUV supply chain. This allows them to scale production rapidly across their global fabrication facilities. They do not have to wait for new machine installations. This structural agility protects their gross margins from sudden equipment delays. Additionally, the physical interface relies on PHY, physical layer interface circuits, the specialized hardware blocks that manage the electrical signaling between memory and logic. Micron's custom PHY design reduces power consumption by 30% compared to competitors. This is critical for data centers operating under strict TDP, thermal design power. The maximum amount of heat a cooling system is designed to dissipate limits. This physical reality explains why Micron stock surged 19.29% today. The stock closed at $895.88, pushing its market cap to $1.0 trillion. Wall Street is finally pricing in the physical scarcity of memory bandwidth. Standard DRAM is a commoditized cyclical market. In contrast, HBM3E is a high-margin, custom-engineered hardware solution. It requires long-term supply agreements. Micron has already sold out its entire HBM3E capacity through next year. The market is realizing that AI accelerators are useless without Micron silicon. While analysts focus on simple demand models, the physical limits of memory bandwidth are driving the capital flows. Today's massive price movement is a direct reflection of Micron's structural engineering dominance. Quarterly financials showing modest revenue momentum for MU. Micron Technology's ascent to a $1 trillion valuation is not a market anomaly. It is the inevitable result of a massive policy tailwind that has effectively socialized the cost of capital for domestic semiconductor manufacturing. Micron is currently riding a wave of fiscal acceleration where the normalization of the yield curve, the spread between short-term and long-term interest rates returning to historical norms, is signaling a capital-intensive recovery that favors domestic giants over speculative software plays. This is the primary force moving the needle. Wall Street views the Federal Reserve's reluctance to cut interest rates as a general market headwind. But for Micron, this environment acts as a structural filter. When borrowing costs remain elevated, smaller, less capitalized firms are starved of the liquidity required to build out the next generation of high-bandwidth memory facilities. Micron, however, operates within a fortress of institutional support. The cost of capital is no longer a deterrent for them. It is a competitive moat. As the yield curve normalizes, the cost of funding massive capital expenditure projects in Idaho or New York becomes predictable rather than speculative. With revenue growth sitting at 196.3%, Micron is effectively outrunning the interest rate environment. They are not just borrowing to survive. They are borrowing to capture the entirety of the memory bottleneck. The Federal Reserve's current hawkish posture, while painful for the broader tech sector, serves to consolidate the industry around the players who can secure government-backed financing. This consolidation is further accelerated by the tangible reality of the CHIPS Act. We are no longer talking about theoretical subsidies. We are talking about billions in direct cash infusions and tax credits that lower the effective cost of building a fabrication plant by nearly 25%. When you look at the Tax Foundation's analysis of trade policy, you see the true cost of the current tariff regime. By placing aggressive tariffs on foreign manufactured memory components, the government is essentially creating a price floor for domestic chips. This is not free market competition. It is a state-sponsored insulation of Micron's gross margins. Every dollar of revenue growth Micron reports is now shielded by a protective wall of policy. While the market obsesses over the Fed's next move, Micron's management is playing a different game entirely. They are leveraging the government's desire for sovereign silicon to ensure that their supply chain remains the only viable option for domestic AI infrastructure. This is the ultimate hedge against monetary volatility. The geopolitical theater is where this narrative turns from a business story into a survivalist strategy. Micron's exposure to the US-China tech war is not just a line item in a 10Q report. It is the central axis upon which their global supply chain rotates. As the administration tightens export controls on advanced memory, Micron is being positioned as the primary beneficiary of a bifurcated world. By restricting the flow of high-end DRAM, dynamic random access memory, the volatile storage that acts as a workspace for AI processors, to specific adversarial regions, the government has essentially handed Micron a captive domestic and allied market. The risk of supply chain disruption in Taiwan, which still dominates the global logic chip market, has forced every major data center operator to prioritize supply chain security over pure price efficiency. Micron is the solution to that insecurity. They are the safe choice in a world where geopolitical friction is the new baseline. When we see headlines about trade wars, we are seeing the systematic removal of Micron's low-cost, state-subsidized competitors from the board. Socially, the narrative has shifted from tech as a disruptor to tech as a strategic asset. The political backlash against big tech, which once centered on antitrust and data privacy, has been completely subsumed by the urgency of the AI arms race. The public, and by extension the political establishment, now views silicon as a national security imperative on par with oil or steel. This shift in public sentiment has provided the political cover necessary for the massive subsidies and trade protections currently fueling Micron's growth. There is no longer a significant political constituency arguing for the deregulation of the memory market. Instead, there is a bipartisan consensus that Micron must win. This social mandate is a powerful accelerant. It ensures that even if consumer confidence fluctuates or if the broader economy hits a speed bump, the capital expenditure cycle for AI infrastructure will remain untouchable. Micron is the beneficiary of a cultural alignment that prioritizes domestic hardware dominance above all else. The market is not just buying a memory company, it is buying a stake in the infrastructure of a new national industrial policy. With an EPS growth of 756%, the math is clear. The friction of the old world is being replaced by the acceleration of a state-backed, hardware-first economy. Micron is no longer just a cyclical commodity play. It is the bedrock of the new, protected, and subsidized AI industrial complex. MU is trending higher, currently at $895.88. Micron Technology, Inc.'s management is publicly emphasizing the company's recent market cap milestone of $1 trillion, nearly tied with industry giants Eli Lilly and Berkshire. The official narrative is one of celebration, with UBS raising the price target to $1,625 and the stock surging in response. However, let's flip the table and examine the hard signals underneath. Insider activity, or rather the lack thereof, is notable. No significant insider activity has been reported, which could suggest that executives are holding onto their shares, awaiting further growth. Historically, this pattern has preceded continued upward momentum in the stock price. On the other hand, the absence of insider buying or selling could also indicate a wait-and-see approach, as executives might be cautious about the company's future prospects. Micron's management has been using phrases like AI demand and supply chain optionality to describe the company's growth prospects. However, what the lab hears is a potential attempt to paper over the risks associated with the company's heavy reliance on the volatile memory chip market. The phrase shareholder returns is also being used to emphasize the company's commitment to investors, but it might be a signal that management is trying to divert attention from potential underlying issues. A specific PR language decode reveals that when Micron's management talks about investing in emerging technologies, what they might be trying to say is that the company is attempting to diversify its product portfolio to reduce dependence on a single market. However, this language could also be seen as a way to justify increased R&D spending, which might not necessarily translate to immediate revenue growth. The trend in R&D spending is also worth examining. With $3.8 billion allocated to R&D, representing 10.2% of revenue, and a year-over-year increase of 10.7%, it's clear that Micron is committed to investing in its product pipeline. However, this spend is growing faster than revenue, which might signal that the company is trying to play catch-up with its competitors or that it's preparing for a significant product launch. The EPS signal, although not recently available, is an important indicator of the company's financial health. The lab would need to examine the trend in EPS to determine if the company is consistently beating or missing expectations. The R&D trend, as mentioned earlier, is a story in itself, with the company increasing its spend in emerging technologies. This could signal a conviction in the product pipeline, but it also raises questions about the potential return on investment. Institutional flows are another important indicator, with 81.3% of the company's shares held by institutions, representing 3,913 funds. The top 5 institutional holders are increasing their positions, which could be seen as a vote of confidence in the company's prospects. However, this also increases the risk of a potential sell-off if these institutions decide to liquidate their holdings. A 10Q risk factors section would likely flag the company's dependence on the memory chip market, as well as the risks associated with emerging technologies. The lab's PR read is that what management is saying is that the company is well-positioned for growth. But what the lab hears is that there are potential risks and uncertainties that are being glossed over. The company's prepared remarks might be conveniently omitting the potential downsides of its investments in emerging technologies or the risks associated with its supply chain. Cautious auditors would likely flag the company's increasing R&D spend, as well as its dependence on a single market, as potential risks to the business. The lab's final PR verdict is that Micron Technology, Inc.'s management is trying to spin a positive narrative, but the hard signals underneath reveal a more complex story. While the company's market cap milestone is certainly an achievement, it's essential to examine the underlying trends and risks to determine the company's true prospects for growth. The lab will continue to monitor Micron's progress, looking for signs that the company is addressing its underlying risks and uncertainties. The momentum breakdown for MU. RSI sits at 70, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. Micron is currently knocking on the door of its $895.88 resistance. While the broader market sees a simple memory cyclical, the lab sees a high-stakes engineering pivot. The bull case rests entirely on Micron's 1-beta DRAM. This isn't just a spec sheet win. It is a structural advantage in the AI accelerator market. By integrating LPDDR5T, Micron is positioning itself as the primary bandwidth provider for the next wave of AI-enabled smartphones. The forward PE of 8.6x suggests that Wall Street expects these engineering wins to translate into a massive earnings explosion. We are seeing a bullish crossover on the MACD. This signals that the momentum is behind the hardware transition. This is the strongest bull case for the stock right now. But here is what breaks the bull thesis: the physical reality of the US-China tech war. Management is touting the CHIPS Act as a savior. However, the 10Q risk factors tell a different story. Export controls on crucial DDR5 are not just a headline. They are a direct hit to the top line. Micron is currently trading at a trailing PE of 42.2x. That is an expensive entry point for a company whose RSI is currently 70.6. If the 1-beta yield doesn't ramp perfectly at the new Idaho facility, that forward PE of 8.6x is a fantasy. The engineering friction of moving production stateside is always underestimated by analysts who don't understand the thermal and electrical complexities of the 1-beta node. Now for the question that makes the room go quiet. Is Micron's pivot to advanced packaging actually a margin play, or is it a desperate attempt to escape the commoditization of the DRAM market? The lab's analysis of the linguistic shifts in recent earnings prep shows a move away from bit shipment growth toward high-value solutions. In PR speak, that is a white flag on volume. When management stops talking about how many chips they can move and starts talking about the complexity of the stack, they are admitting that the commodity business is under fire from geopolitical restrictions. They are effectively betting the entire company on GDDR6X. If the AI accelerator market sees even a minor digestion phase, Micron has no safety net. They are trading at 97% of their 52-week high, leaving zero room for an engineering stumble or a yield miss. This linguistic shift from revenue to margin is the clearest signal of hidden stress. The lab's final verdict is clear. Micron is a high-performance machine running at its thermal limit. Our AI score is 66 out of 100. This reflects a stock with massive potential but significant structural heat. We are watching the $895.88 resistance with extreme caution. If MU cannot break and hold that level on heavy volume, the support at $504.29 becomes the new reality. This is not a buy and hold scenario. This is a watch the yield scenario. The forward PE of 8.6x is the bait, but the trailing PE of 42.2x is the hook. We are staying neutral until the 1-beta DRAM ramp proves it can survive the loss of the Chinese server market. No fluff, no hedging, just the silicon reality. Micron isn't just leading the memory rebound. It's running away from the pack on revenue growth, with a 196.3% surge that obliterates every peer in the semiconductor capital equipment and storage space. But growth alone doesn't win races. The real question is, who's growing profitably, efficiently, and sustainably, and who's priced like they've already won? Let's break down the field. Lam Research trades at a 61.0x P/E, commands 50% gross margins, and grew revenue 23.8%. They're not chasing explosive top-line turns. They're extracting margin discipline in etch and deposition, where tool demand stays sticky across cycles. Their YTD plus 38.1% reflects steady execution, not speculation. Yet even at that premium, Lam's growth engine pales next to Micron's 196.3%. But here's what Wall Street misses. Micron's growth is a cyclical catch-up, not a structural shift. DRAM and NAND pricing spiked. Yes, but Lam's tools sell into long-term node transitions. Their margin durability is real. Micron's growth is temporary. Then there's Western Digital, up 87.7% YTD, trading at $524.65 with a 31.5x P/E, 45% gross margin, and 45.5% revenue growth. WDC isn't anywhere near Micron's growth rate, but they're executing a clean pivot from consumer storage collapse to enterprise and AI-adjacent data center demand. Their cost structure is leaner, their exposure to PC and mobile less volatile. And at half Micron's PE, assuming you could even calculate one, since M-use is not applicable, WDC looks like a value play with momentum. Now, valuation. Micron has no PE. That's not a typo, it's a red flag. The market isn't pricing Micron on earnings. It's pricing on narrative, AI memory scarcity, HBM3E ramps, eternal DRAM tightness. But LRCX and WDC are growing on actual profitability. Micron's gross margin? Not provided. But we know LRCX prints 50% and WDC hits 45%. If Micron can't match that, its 196.3% revenue surge is just revenue, not profit. And revenue without margin is volume without value. Capital efficiency? Lam wins. 23.8% growth at 50% gross margin with pricing power. That's the gold standard. WDC delivers 45.5% growth at a third of Micron's multiple, far more efficient capital deployment. Micron's growth is explosive, but it's capital-intensive, margin volatile, and tied to commodity memory cycles. Here's the verdict. Micron's current price isn't just rich. It's pricing in perfection no memory maker has ever sustained. The lab sees better risk-adjusted upside in Lam Research for structural margins and in Western Digital for balanced growth and valuation. Micron isn't the best horse. It's the most hyped. And in this cycle, that's a liability. Micron's DDR5 ramp and D1X fab expansion signal a clear inflection in margin power. After this deep dive, are you a buyer of MU right now or still on the fence? Tell us why. We're engineers, not advisors. This is for education only. Do your own research, not financial advice. Past performance doesn't guarantee future results. We analyze, you decide. Stay sharp and keep building the future.